Welcome to Econ Saga, where we decode financial mysteries. Today we expose the silent accumulation of silver by a banking giant. For 15 years, J.P. Morgan has quietly built a fortress of silver, a strategy that is now reaching its terrifying climax. While the world focused on stocks and crypto, this institution was hoarding a physical asset that has served as money forever. This was not a short-term trade, but a calculated 15-year plan designed to corner the market completely and totally. They understood something that most investors missed, which is the undeniable truth that physical assets eventually trump all paper promises. Resources from across the globe have been siphoned off slowly, moving from miners into the deepest vaults of one single entity. The scale of this operation is unprecedented in history, involving logistics and storage capabilities that rival the reserves of sovereign nations. To understand the future of the global economy, we must first dissect exactly how this massive silver hoard was actually built. It involves legal battles, huge fines, and a mastery of market mechanics that allowed them to accumulate without spiking the price. Now that the trap is set, the next phase begins. Let us dive deep into the numbers that define this saga. As of January 2026, it is estimated that J.P. Morgan holds approximately 750 million ounces of silver. To put that into perspective, that is a mountain of metal so large it is difficult for the human mind to comprehend. This hoard represents nearly one entire year of mining production from every single silver mine operating on the planet Earth. Think about the labor, energy, and time required to extract that much metal, all now sitting idle in one bank's possession. These stockpiles are strategically located in key financial hubs, giving them instant access to liquidity whenever they decide to sell. While central banks printed trillions of dollars, this bank exchanged that depreciating paper for a hard asset with intrinsic industrial value. But how did they buy so much without the price exploding? The answer lies in a controversial strategy called market spoofing. They utilized the futures market to create an illusion of massive selling pressure, scaring away retail investors and other funds. By keeping the paper price low, they could acquire the physical metal at a discount, effectively robbing the producers of value. This accumulation was not done on the open public exchanges, but often through private deals that never impacted the ticker price. Regulators eventually caught on, but the fines paid were merely a cost of doing business compared to the long-term gains. In 2020, they paid nearly $1 billion in fines for manipulating precious metals. Yet their accumulation strategy never stopped. They played the long game, ignoring short-term noise to secure a position that makes them the masters of the market. But now, the time for accumulation is over. The strategy has shifted, and the market is about to feel the impact. From June to October 2025, we witnessed a historic pivot. They closed their short positions and went aggressively long. This signals that they no longer want the price to stay low. They have filled their vaults and locked the doors. The incentives have flipped. Now, every dollar increase in the price of silver adds billions to their balance sheet value. They are positioned for a moonshot. After 15 years of suppression, they are now the biggest beneficiaries of a price explosion. This brings us to the fragile state of the COMEX, the primary exchange where silver prices are discovered and traded globally. The market is flooded with paper contracts that claim to represent silver, but the physical metal backing them is dangerously low. For every single ounce of registered silver available for delivery, there are 24 paper claims fighting to own that same ounce. It is a high-stakes game of musical chairs. When the music stops, 23 people will be left holding absolutely nothing. If confidence in the paper market collapses, investors will demand delivery, and the exchange will simply not have the metal. This scenario creates the perfect storm for a short squeeze that could send prices far beyond their historical all-time highs. Adding fuel to the fire is the new policy from China. As of 2026, strict export controls are effective. China refines up to 70% of the world's silver and has now declared it a strategic metal for national security. They are keeping the metal for themselves to fuel their own massive green energy transition and high-tech manufacturing sectors. This creates a supply bottleneck for the rest of the world. The flow of refined silver to the West is drying up. We are already seeing a price disconnect. Silver in Shanghai trades at a premium compared to the suppressed paper price in New York. This arbitrage opportunity cannot last forever. Eventually, the Western prices must rise to meet the physical reality of the East. Beyond finance and geopolitics, the industrial demand for silver is entering a parabolic phase due to the artificial intelligence boom. Silver is the most conductive metal on Earth. It is irreplaceable in electric vehicles, 5G networks, and advanced electronics. The solar industry alone consumes nearly 20% of annual supply, and newer panel technologies require even more silver per unit. As we build the infrastructure for the AI revolution, we are consuming silver faster than we can possibly mine it. We are facing a structural deficit. Demand is exploding, while mine supply is stagnant due to years of underinvestment. It takes 10 years to bring a new mine online. The supply response to high prices will be slow and painful. J.P. Morgan foresaw this perfect storm. They positioned themselves ahead of the curve, waiting for the inevitable supply crunch. For the average investor, the window to acquire physical silver at reasonable prices is closing rapidly as shortages appear. When the panic starts, you will not be able to find metal. Premiums will skyrocket, and inventory will vanish overnight. History has shown repeatedly that when fiat currencies falter, the world turns back to the safety of gold and silver. With global debt at unsustainable levels, the purchasing power of paper currency is destined to continue its downward spiral. Owning physical silver is not just an investment. It is insurance against the mismanagement of the monetary system by elites. The difference between holding a paper promise and holding the real asset will become the defining lesson of this decade. The banking giants have made their move. They have voted with their wallets, and their vote is for physical silver. The game has changed. Silver is no longer just a commodity. It is a strategic asset in a changing world order. As we move forward, watch the actions of the smart money, not their words. Their actions scream that silver is undervalued. The melting point of silver is high, but the melting point of the current financial system might be much lower. We are on the verge of a breakout that could redefine wealth transfer. Are you prepared for what is coming next? The convergence of banking accumulation, geopolitical restriction, and industrial necessity creates a bullish case that is impossible to ignore. Secure your position. Do your own research. But do not ignore the signals that the biggest players are sending. This has been a special report from Econ Saga. We track the money so you can understand the world better. To fully grasp the magnitude, we need to look at how central bank policies have enabled this massive accumulation phase. Easy money policies provided the liquidity that allowed banks to leverage their positions and manipulate the paper markets effectively. With interest rates near zero for years, the opportunity cost of holding non-yielding assets like silver was negligible. Retail investors were discouraged by the lack of price action, selling their silver to the very banks that suppressed it. It was a classic transfer of wealth, from the impatient to the patient, from the weak hands to the strong hands. The visual difference in their holdings over 15 years is striking. They turned a localized position into a global monopoly. Supply from the world's largest producers in Latin America has been systematically absorbed into this singular, massive strategic stockpile. Labor disputes and political instability in mining regions are further threatening the supply chain, adding to the scarcity narrative. Rising energy costs make mining more expensive. The floor price for silver must rise just to cover production costs. Ore grades are declining. We are finding less silver per ton of earth moved, making the metal harder to obtain. Recycling cannot fill the gap. Recovering silver from electronics is difficult, expensive, and currently accounts for a small fraction of supply. The market has been in a physical deficit for years. We are consuming more silver annually than we are producing. We have been eating into above-ground stockpiles to meet demand. But those stockpiles are now critically low. Silver's unique chemical properties mean it has no substitute in many high-tech applications. Industry must pay any price. From aerospace to defense systems, silver is crucial. Governments cannot afford to run out of this strategic material. Its antimicrobial properties also make it vital for healthcare. The utility of silver extends far beyond just being money. Smart investors look for assets with low downside and high upside. Silver at current prices fits this profile perfectly. The gold-to-silver ratio suggests silver is undervalued. Historically, this gap always closes, usually with silver rising faster. Time is the critical factor. The longer the suppression lasts, the more violent the eventual price correction will be. J.P. Morgan has switched sides. They are no longer the seller, they are the buyer. Do not bet against them. Just as nature follows cycles, markets do too. The winter of low prices is ending. The spring of growth awaits. In an era of digital surveillance, physical silver offers privacy and autonomy that no digital asset can truly match. If the power goes out or the internet fails, your digital wealth vanishes. Physical silver remains in your hand. It is a legacy asset. It preserves purchasing power across generations, surviving wars, famine, and currency collapses. As the dollar weakens, the inverse correlation strengthens. Silver is the ultimate hedge against the devaluation of fiat currency. Global imbalances are correcting. Nations are moving away from the dollar standard and accumulating real reserves like gold and silver. The BRICS nations are leading this charge, challenging the Western financial hegemony with commodity-backed currencies and trade agreements. A return to sound money is inevitable. When trust is lost, only tangible assets can restore faith in trade. From the vaults of New York to the factories of China, the story of silver is the story of our future. Thank you for watching this detailed analysis. Subscribe to Econ Saga for more insights into the shifting global economy. Goodbye. Consider the Roman Empire. When they debased their silver currency, their empire collapsed. History often rhymes with the present day. In the 1970s, silver rose from $1 to $50. We may be setting up for a similar move. Even Warren Buffett once bought 130 million ounces, recognizing the fundamental supply and demand imbalance back then. J.P. Morgan's position today dwarfs what Buffett held. They have taken the bet to a completely different level. Silver ETFs are another factor. If investors flock to them, the funds must source physical metal, squeezing the market further. However, beware of paper claims. Read the fine print. Many funds can settle in cash if metal is unavailable. This is why physical possession is key. If you do not hold it, you do not truly own it. Wealthy individuals are moving their metal to private vaults outside the banking system, reducing the float available for trading. India imports massive amounts of silver for jewelry and investment. Their cultural affinity for precious metals drives huge physical demand. When the price dips, India buys. They provide a floor under the price, absorbing any excess supply that appears. The rollout of 5G networks globally requires silver for components. This is a new source of demand that is growing. The commercialization of space and satellite technology also leans heavily on silver for its reliability in harsh environments. As the world seeks carbon-free energy, nuclear power is returning, and it too utilizes silver in specific reactor components. Silver is used in water purification systems. As fresh water becomes scarcer, this application will only become more critical. Even the textile industry uses silver nanoparticles for odor control in clothing. The uses are endlessly expanding and diversifying. Once silver is used in these industrial applications, it is often lost forever in landfills, unlike gold, which is hoarded. We are throwing away silver every day. We are consuming a finite resource as if it were infinite. Geologists warn that peak silver may have already passed. The easy-to-find deposits are gone. Only the hard ones remain. Future mining may require deep-sea extraction or asteroid mining, both of which are incredibly expensive and years away. Inflation hits miners hard. Fuel, tires, labor, and explosives all cost more, driving the break-even price of silver higher. Strict environmental regulations make it harder to open new mines. The barrier to entry for new supply is very high. Social opposition to mining is growing globally. Nobody wants a mine in their backyard, yet everyone wants the technology. This is the green energy paradox. We want a clean future, but we block the extraction of metals needed to build it. J.P. Morgan understood this contradiction. They knew that inevitably, the price mechanism would have to resolve this deep imbalance. When the price breaks free, it will be violent. It will act like a beach ball held underwater for too long. For those who position themselves early, the rewards will be substantial. It is a transfer of wealth to the prepared. However, do not chase the market blindly. Strategy requires patience and a clear head, not emotional reactions to daily volatility. Consistent accumulation over time, like the banks did, is often a safer strategy than betting everything on one moment. Silver should be part of a diversified portfolio. It is the defensive shield that protects your offensive growth assets. Remember that markets can remain irrational longer than you can remain solvent. Leverage is dangerous. Avoid it if possible. The derivatives market is a house of cards. When it falls, the only thing left standing will be the foundation. Silver is that foundation. It has no counterparty risk. It does not rely on a promise from anyone else. As governments push for central bank digital currencies, the anonymity of physical silver becomes a premium feature for privacy. It allows for peer-to-peer trade without surveillance or permission. This freedom is becoming increasingly valuable in our digital age. Looking ahead, the future is bright and electric. Silver is the conductive thread that weaves this future together. We are witnessing the dawn of a new commodity supercycle. Hard assets are reclaiming their throne from financial abstractions. J.P. Morgan has secured their seat at the table. The question is, have you secured yours before the music stops? 750 million ounces. That number will go down in history as the greatest trade ever executed. 15 years of patience and manipulation. A masterclass in market psychology and strategic positioning by the banking elite. Physical scarcity is the catalyst. The disconnect between paper price and physical reality cannot exist for much longer. China's export ban is the accelerant. It forces the West to face the reality of its own supply chain fragility. Industrial demand is the floor. The green revolution and AI ensures that silver will be needed more than ever. The only way to balance this equation is price. The price must rise high enough to incentivize new supply. All these tributaries are flowing into one massive river of liquidity that will lift the price of silver significantly. You stand at a crossroads. One path leads to devalued currency, the other to the preservation of true value. Taking action requires courage. It means going against the herd and trusting in fundamental analysis over hype. Join our community of critical thinkers. We navigate these turbulent waters together, sharing knowledge and staying ahead of the curve. If you found this video valuable, share it. Help others understand the silent financial war that is taking place. Hit the like button to help the algorithm and let us know in the comments. Do you own physical silver? What is your price prediction for 2026? We read every comment and value your perspective on this market. Stay tuned for our next report where we will dive into the gold market and its relationship with digital currencies. The economy is global connected and constantly evolving. Understanding these connections is your best defense against uncertainty. Every gear matters. JP Morgan is the big wheel, but retail investors are the small cogs that can jam the machine. We are nearing the end of the tunnel. The suppression era is ending. The price discovery era is beginning. Growth will come. Wealth will be generated. Make sure you are positioned on the right side of this historic transfer. Just as the stars remain constant, the value of silver has remained constant for 5,000 years of human history. Econ Saga is here to illuminate the path. We thank you for your time and your trust in our analysis. The story of silver is far from over. In fact, the most exciting chapter is just about to be written. Until next time, keep your eyes open, stay skeptical of the official narrative, and protect your hard-earned wealth.